Good morning and welcome to this Wednesday. Unbelievable Wednesday. It seems like this week's going by pretty quick. Anyway, welcome to this Wednesday, February 2nd, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. I don't know, it seems like it's like Monday or Tuesday to me. I'm not sure why, but anyway, it is Wednesday. We've had some, a lot of earnings coming in. So far, some of the big companies continuing to hold the market up. We saw Apple come through with a big report. Microsoft had a big report. Last night, it was Google's turn. Google had a huge report. Google's actually trying to open, or earlier was trying to open at an all-time high. I mean, it's having a huge morning. But then we had a really sour ADP employment report this morning. So, I mean, it is going to be crazy. When I said at the beginning of the year, this was going to be a wild, volatile year, I had no idea it was going to be quite this crazy in the first 5 weeks. But that's what we've got. And unfortunately, that's what we're going to have to deal with here throughout 2022, at least the first half. I think the swings are going to be absolutely crazy. And even though, now the market kind of has a different feel to it. You know what I mean? I mean, we've had 3 big days back to the upside. Now, all of a sudden, everyone seems to be forgetting about all the weakness and all the problems that we were having just a week ago, not even a week ago. And that's how the market works. I mean, you get whipsawed in both directions. It looked like for a couple of days there that we weren't even going to bounce off of 4,300. Now it looks like we can't stop this market. We got this runaway market back to the upside. I think we got problems ahead. And I still, regardless of the move to the upside here, I mean, we weren't going to go straight down for 6 months. We're going to get bounces along the way. I think that we're getting one here. How far it goes, market kind of does its own thing. It's kind of hard to say. You can look at certain levels, and we're going to talk about that, but it's still a difficult thing to say. Right now, futures just slightly up on the Dow Jones. S&P 500 futures up a little bit more, about 0.75%. NASDAQ futures are where it's at this morning, up over 1.3%. Of course, a lot of that due to that really strong report from Google or Alphabet. I still can't get used to calling them Alphabet. To me, it's always going to be Google. I don't alphabet something. I Google it. So I don't know, just me. Anyhow, yeah, they ought to just go back to Google. I don't know why they switched to Alphabet. I don't hear anybody call them Alphabet. I don't know. Again, maybe it's just me. All right, a lot to go over today, but first, let me take you over to Earnings Beats. For those of you who are new to Earnings Beats, just want to make sure you're aware. If you go over to earningsbeats.com, we do have a free newsletter, our Earnings Beats Digest newsletter. All it takes is a name and an email address. Hit that subscribe button. There's no credit card required. You can unsubscribe at any time. We do a lot of free events. So another reason to be on this list is when we have a free event, we send out invitation to everybody in our EB Digest community. So if you're on there, then you won't miss any of these events. And not only can you come live, but also you'll get recordings if you can't make it live. So there really is there's a number of benefits to being an EB Digest subscriber. We do publish this 3 times a week, Mondays, Wednesdays, Fridays, normally out about an hour before the market opens, maybe a little more, maybe a little less. Usually it's my fault if it's a little bit less. I usually get things to Aaron just a little bit later. But, we do try to get that out for the most part before the market opens. A lot of it is just, teaching you or helping to educate some of the things that are really important to us, revolving around earnings, relative strength, gaps, candlesticks, those types of things, trend lines, moving averages, the things that we look at in terms of trying to manage our risk. But we get into a lot of other things too. I mean, we'll talk about sentiment. I'm going to spend quite a bit of time this morning talking a little bit about sentiment and why I don't believe this rally is going to last. And I may be wrong. I've been wrong plenty of times before, but when I get warning signs, I heed them. And sometimes it costs me, but a lot of times it'll save me a bunch. And so anyway, we'll get into all that. So going over to earningsbeats.com, make sure you sign up if you haven't already. All right, well, let's just jump into the market. I mean, yesterday was another pretty good day. We didn't do much until about 3 o'clock, and then the last hour. And if you notice one thing about the market when it's trending, afternoons, when you're in an uptrend, the afternoons tend to be stronger. And when you're in a downtrend, the afternoons tend to be weaker. A lot of times in a downtrend, if you see strength, it's in the morning. Early move into positive territory and then down from 11 or 12 o'clock on. Well, in an uptrend, it's usually the opposite. If you're going to see any weakness, it's normally in the morning. And then usually end of the day, you're seeing buying into the close. So if you're thinking, okay, well, when are we going to see a potential move back to the downside? Well, you can't start a downtrend until you put in a lower daily low. I mean, as long as we keep putting in higher lows every day, the uptrend's intact. So first thing you have to do is pierce the prior day's low to at least start to see the chart roll over. Until we get that, we're in an uptrend. Anyway, Dow Jones Industrial Average up 273 yesterday, S&P 500 up 31, NASDAQ up 106, 0.75%. Nice move there. Mid caps up more than 1%, up 27 points. Small caps up 10. That's about 0.75%. And you can see fairly similar action across these 5 indices. Broke down, held support. Well, broke down intraday, came back up, held support. That was the case on both the Dow and the S&P 500. NASDAQ mid caps, small caps all broke down below those prior lows, went to 6-month lows. And these rallies are up against our key moving averages, either the 20-day or the 50-day. The Dow's moved through the 20, the S&P 500 moved slightly through the 20. NASDAQ, mid cap, small caps have not negotiated their 20-day yet. Trying, they haven't quite made it. NASDAQ's going to pierce it on the open today unless something really changes here in the next 10 minutes or 20 minutes. Looking at the sectors from yesterday, different leadership yesterday, if you noticed. Energy back on top, the clear leader. Energy is by far the best performing sector right now. Materials also coming back up to test the 20-day. That was the second best group yesterday. And financials and industrials were in the 3rd and 4th spots. Notice what's missing here. What was leading on Monday? We had technology, consumer discretionary, and communication services. The 3, what I would call, the really aggressive. I mean, when those groups are leading the market to new highs, I will not be more bullish. That's always a great sign. And on Monday, we saw that leadership. We haven't seen it much this year, but we saw it yesterday, or we saw it Monday. But yesterday, they were gone again. There's the top 4 sectors. None of those 3 were in the top 4. So money already looking like it might be rotating away from them. Communication services is going to get a big lift from Google today. So we'll see whether or not, it holds those gains. And that would be one thing I would watch today, honestly, on Google, is do we make the breakout? We've never had an open or a close above 3,000 on Google. We closed yesterday 27 and change. This morning, I think we were trading at 1.3040. Last time I looked, it was 3,005. We'll take a look at that in just a couple minutes. But if it opens under 3,000, I'd be a little nervous that it's going to set a high on the open. If it opens above 3,000, that's a little bit more of a bullish signal to me from the market makers, because they know where the resistance is. And if they allow a stock to open at above resistance, it's going to likely create more buyers. So if you're trying to get your institutional clients out of stocks, you would tend to open the stock beneath that key resistance level, because that would trigger more selling. And then, at that point, that's when you would expect that a stock like Google would top. And with all the selling, you would come back down. Now, we could have a false breakout. It's not like that never happens. But I would say the odds are certainly greater to Google going higher if it opens above 3,000 versus below 3,000. We'll see how that works out here in about 20 minutes. Utilities was the only group that was down more than 1% yesterday, down 1.33%. It's made a little bit of a rally off its recent low. Overall, though, this is one group that maybe not nearly as strong as energy. It does have an uptrend in play. You can see the higher highs, you can see the higher lows. So we do have a nice little uptrend. Not as much, maybe a little bit on the materials. Same with financials, industrials, just kind of sideways. But if you look at some of the other key groups like the technology group and consumer discretionary, Short term, we definitely have a downtrend in play in those groups. And that's what's been causing a lot of that relative weakness in the NASDAQ. All right, let's move on and take a look at the 10-year Treasury yield. I don't know if you saw the ADP employment report that came out this morning. It was not good. Now, last month, it came out with like 800,000, which blew away estimates, but then non-farm payrolls came in much lower. So it wasn't a great signal. And that's usually what everyone's looking at on Wednesday. It's like, okay, the ADP employment report. Keep in mind, ADP employment report only includes private payrolls. So no government payrolls. Non-farm has both on Friday. So we're only looking at the private payrolls. But this morning, the ADP employment came in. This is for January. Well, the expectation was a rise, a gain of 225,000 jobs. Instead, we had a minus 301,000. Now, maybe that big beat we had last month, maybe it's just being reversed this month. I don't, dig into the numbers and see how they come up with this. But we've got a Fed. I mean, I saw a report yesterday. Trying to think who it was. Someone said that they were expecting the Fed to raise rates 7 times this year. I just don't see it. I don't know. Maybe I'm the one that's just way off, because I'm seeing Goldman Sachs calling for 4 or 5 rate hikes. This other firm I saw yesterday, 7 rate hikes. The Fed's already acknowledged that they're planning to hike rates a few times. Maybe I'm just missing something here. I mean, I saw the retail sales the last couple of months, which have been absolutely horrid. And then I see the ADP employment report this morning, which now goes negative. And, sometimes when you're looking at the market, it's almost like when the market is going up, you're in a bull phase, bull rally. It almost seems like whatever news comes out always gets spun to be good news. Yeah, jobs are strong. That means the economy's strong. Oh, jobs were weak. Well, that means that the Fed's not going to raise rates. That's good. So it's always something that makes you want to be in stocks. It's always that positive mindset. I almost feel like we're in the opposite right now. A strong jobs report is probably the last thing you want when you're wondering if the Fed's going to raise rates. I mean, if they get, if they signs of economic strength, it's like, wow, they're going to have to raise rates. This is going to be bad for inflation. The economy's really picking up. And then on the other hand, when you see the weak employment report, you're thinking, my gosh, weak employment going negative, jobs negative in an environment where the Fed's going to be raising rates. Ugh, that's nasty. So I'm not sure that it's going to matter what these jobs come in. I'm thinking that maybe with Friday's non-farm payrolls, maybe that's the top in the short term. And I'm just speculating, just like everybody else. But I do have some interesting charts. One in particular I'll show you that kind of supports the theory that this market's got some issues it's going to have to deal with. Anyway, 10-year Treasury yield, let me just get you an update here on this. So with that jobs report, very, very weak. The 10-year Treasury yield really hasn't budged. It's still sitting up at 1.80. Did open a little lower this morning, but it's rallied back and it's pretty much unchanged. So you think the weak ADP employment report, maybe we'd see rates fall a little bit, but they're not. They're staying up there, and I think that could be problematic for the market in the short term, because again, if rates are going up because of a strong economy, I think that's very bullish for the stock market. But when rates are going up and the economy is showing signs of maybe stagnating, that's a bad combination for the stock market. So something to at least be thinking about considering. All right, let's move on. I'm going to show you first the NASDAQ. So here's a bounce. Now, we knew we weren't going to go down forever. I mean, the NASDAQ dropped from almost 16,000 down to almost 13,000 in 3 or 4 weeks. Now, outside of the pandemic, where we saw that 35% drop in 4 weeks. I mean, outside of something like that, this is a really significant drop for the market in such a short period of time. So we were bound to bounce. And in fact, last Monday, in the DMR that I wrote, I actually wrote a very brief one, like 10:15 or 10:30 that morning, because the volatility index had gotten to 38 at that moment. We did actually get to 39 and peak there. But anytime you get into the upper 30s, you are nearing, very likely, you are nearing a major bottom in the market, at least near term. And so that went out literally almost right near the bottom. I think we were down below 4,300 on the S&P. And then we ended up going down a little bit further to 4220 or whatever that low was. This is the NASDAQ, but the S&P low, I think, was right around that 4220 area. Anyhow, that marked the bottom. And after a little bit of sideways action, you can see now we're rallying back. It's almost like a rubber band. That's why I always, describe the VIX. When the VIX gets up to like 30, into the mid upper 30s or even into the low 40s, that's like the market is selling off so fast that rubber band's being pulled back, and then all of a sudden somebody lets go of the rubber band and then snaps right back. And here's the market snapping right back. All right, so there's the 20-day. Now, 14,250 was kind of a big level. I mean, we've tested on the NASDAQ to the upside 14,250 multiple times, to the downside multiple times. So we've gone right back through it. Does that mean everything's behind us and things are more bullish? Well, I mean, in a way, when you start going through resistance levels, you have to respect that. Do I think that this means that we can't go lower again because we're going to open above the 20? No, I'm not thinking that at all. In fact, we might see a big red candle today. We might see a big gap up because of the earnings, and then we might see selling all day. We have no idea what we're going to see on this, what this candle is going to look like by the end of the day. Now, short term, if we gap up and we trade up to 15,000, we put another 600 or 500 points on the NASDAQ today. Yeah, that's going to start looking a lot more bullish. It's going to, maybe change a lot of opinions. I still think we've got issues. I think probably what it means is just more volatility, but it would probably put some of the, I'm thinking still head and shoulders pattern, especially on the S&P 500. We went through this low right here on the NASDAQ, but if I pull up the S&P 500, you'll see that we went down intraday. There's that 4220 low I was talking about. So intraday, we went down below, but we held. That's a neckline right now. So I'm thinking this move back up is the right shoulder. Now, normally what I would want to see is a lower right shoulder than left shoulder. Well, I think we're right at yesterday's close. I think we were right at this left shoulder. So we would need to turn around pretty quickly here to have that. That would be pretty symmetrical looking right or head and shoulders top right now, with the left shoulder and the right shoulder about the same, neckline even coming across, and then with that higher head. So it's still in play, but the further we go up, the less to me it looks like a right shoulder. I mean, we don't totally negate the pattern until you break out above the head. But, I feel it's more bearish to have a lower number on the right shoulder than you have on the left. But that doesn't mean you still can't have a breakdown. Whether you call this a neckline or whether you just call it support level, if we break 4,300, that is not going to be good, whether you want to use a head and shoulder measurement or not. So that's going to be a level. That is the level, in my opinion, that we need to watch. If we close below 4,300 on the S&P 500, I believe we're going under 4,000. I think that will be the step that takes us, first step that takes us below 4,000. So I would be watching that level and making sure that level holds. If you're, if you like to trade on the long side, I think that's a really critical level to continue to hold. The right side, I mean, we had resistance 4,500 right here. We went through it. We had the 20-day. 45.31. We closed just above it. We've got some other prior lows that we're going to have to deal with at some point. Maybe watch the hourly charts, look for negative divergences to start to emerge there. There's a lot of things, that we can be looking at. But the big problem I have with the market is sentiment. And we saw, sentiment issue, more of a short-term sentiment issue, develop in November when the VIX went up with the S&P 500. That happens during all kinds of different markets. You don't have to be, that doesn't necessarily signal a bear market. It normally is just a short-term issue that, can sometimes take the market down a few percent, that kind of a thing. So that wasn't the big issue. The bigger issue was when we got into December and we started seeing defensive groups leading the market to the upside. And then also the extreme bullishness in the options world, looking at the equity only put call ratio. So that's where I want to go with this next chart. Now, this is the daily equity only put call ratio for the last 10 years. Now, you see it's all over the place, and maybe you're like, well, what the heck is that EKG? What, I don't know what's going on here. Well, I'm not really worried that much about what's happening on each individual day. What I'm kind of worried or looking at is the range. Get rid of all the outliers that you see at the tops and the bottoms, these thin lines that go shooting up or down, and just look at kind of the meat of this thing. And you can kind of see the meat was drifting lower and lower and lower, 2012 to 2014. Remember, we got to the middle of 2014 and we went through 18 months of not so good market action. What happened? Well, we were very, very complacent on the options side of things. Everybody felt like, from an options perspective, that the market simply couldn't go down. So what does the market do? It goes through 18 months of torture until this sentiment, look at the body again, look at the body starting to move up. And then we get to a point where we're very pessimistic again. Beginning of 2016, it looked like the market was breaking down. It felt horrible. It's like, oh my gosh, here comes 2007 to 2009 all over again. That's how you mark a bottom, by getting that sentiment back up. 2016 all the way into 2018, you can see that body again creeping lower and lower and lower until we finally went through this period where we kind of stabilized, move up a little bit. This was all of that craziness that we saw with the trade war and the pandemic. Then after the pandemic, market just kept going up, 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 up. S&P 500 more than doubled off the low in March of 2020 through the high we just saw when it was over 4,800. It was below 2,200 in March. So during this period, while the S&P is just going up, 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 look at the body of this little creature here. It had moved down lower than at any point over the last 10 years. So everybody just feels like in the options world that you get a little pullback, you just buy more options, you just buy more calls. Market's going to rebound. It always does. Anybody coming in, the Reddit folks that got involved in the market, back in 2020 and 2021, the big short squeezes, I think end of January of 2021, GameStop, all of that, they don't know what a bear market looks like. They've been trading, and a lot of folks, I've talked to my son a little bit who's gotten into trading last year or so. And he's like, I don't know what a bear market looks like. I haven't been in a market where, it goes down. And that's what needs to change. The market needs to feel the pain. People need to feel the pain in order to reset. And I think we're just starting this. If you notice, we're starting to move up on both the highs and the lows on the put call ratio. Very similar. Here was the down. You were going down, and then we start going up. And I think we're in the fairly early stages of this going up. I think in the first half of this year, we're going to see this rise quite a bit. And we're going to start seeing equity only put call ratios start to reach back up in the 0.90s, maybe even go above 1 on an occasion or two. That's when we're going to know that the sentiment is getting to a point where, it can make a difference. And that's where the market can then launch again from. I'm going to show you one other chart of the equity only put call ratio. And this is one that to me is unbelievable. Up at the top here, this is the equity only put call ratio, but down here, I put it under the type I put is invisible. So it gets rid of all of this individual stuff, all this noise that you see on the chart. This is every day's reading for 10 years. And what this chart does is it smooths it out. This is a 253-day moving average, a 1-year moving average. And the peaks and troughs of this chart line up so well with changes in market direction. I mean, it's almost amazing that something that lags that much, a 253-day moving average, when it peaks or when it bottoms, it has such a major impact on the market. I'm going to annotate this and just show you. So there's a peak right there. There's a bottom. There's a peak. There's a bottom. There's a peak. There's a bottom. Right in here, this whole mess. This was just not really showing as much of anything. Up, down, going sideways mostly. And look what the market was doing. Market couldn't make up its mind either. Then we got to the point where market just went straight up, and you can see the put call ratio coming down. Now think about put versus call. It's a put call ratio, puts divided by calls. So as this number is coming down, it's telling you that the number of puts at the top is getting much lower than the number of calls, which is on the bottom, the denominator. So as that numerator versus denominator gets lower and lower, this comes down. It means fewer puts are being bought. Market's getting very bullish. The options world is getting very bullish. Now, if we look at these peaks right here, here's a peak. This is when things are extremely bearish. I mean, everybody's been buying more and more and more puts, fewer calls. When we got to this peak right here, it was right at the market bottom. Then we go through this period where we reset sentiment, get very bullish. We had a great move up. While everything's coming from bearish to bullish, you explode in the market. But then once we got to this bottom and we got very complacent, look at what happened. We didn't sell off. We didn't have a huge sell-off, but for probably 15 months, we went nowhere on the S&P 500. Very choppy, very volatile back and forth. And that was when we were seeing this equity only put call ratio rising. Then we top and we go back down. What happens? We have one of the best parts of our bull market, straight up, hardly any pullbacks along the way. Then we go up on the put call ratio and look at the choppiness and the big selling and the sideways action. Then the put call ratio, this average starts dropping again. What happens? I think we went through at one point the longest period in history without a 3% drop in the S&P 500. I remember that from back in 2017. We went all year. The S&P never had a 3% drop. I mean, we can get a 3% drop in a day right now if it's a bad day. Never had a 3% drop the entire year. And that was when we were resetting the sentiment back to the downside. Then we went through this period. I mean, my gosh, between the trade war and the pandemic and everything that was going on, I would just toss it. I don't think it was really giving us much of a signal. But coming out of the pandemic, look, we've now gotten to a level nowhere. I mean, we are so far down here in terms of few puts being bought versus calls. And we're just starting this move to the upside. Look what's already happened. Now, again, this doesn't mean we're going to have a bear market, but after going up 100%, over 100% in less than 2 years, I would say that we're probably due for maybe a little pullback. I mean, if we came back to 37.50 and then ended up going back to 47.50 on this chart, would you be shocked? I mean, I wouldn't. We had a huge move up. Yeah, it's not going to feel good while in the moment. Of course, the headlines are going to, it's going to be the end of the world. But I think at that point, I think we're going to get to a point where inflation tops. And when inflation tops, I think the market's going to bottom. Now, whether or not the market forecasts the bottom before we hit the top in inflation or how that's going to all play out, we'll, have to keep monitoring. But I don't think we've seen the low. I just, I said the other day that I would, 70% chance I think we go back below that 4,300, 70-30. And with this big rally, and if we get, continued move up after the Google-led gap this morning, then maybe, maybe that drops to 60-40. But I still believe the odds are that we go back down and we go through that 4,300. And this is one of the reasons why. Even after this move down, look at where the 1 year moving average of the CPCE is. And we're just starting this. So if it turns out to be one of these moves or one of these moves, we could be in this for a while, this volatile back and forth, awful action. And if you're somebody who tends to trade emotionally, where you wait and let the market do its thing and then jump in and follow the market, this kind of a back and forth market will be very dangerous. So, I'm just giving you caution. Whether or not the market does have problems or whatever, I don't know. But I do know that the signs are there telling us to be careful. And so, and everybody listens to me, I tend to be very bullish the market. If I'm bearish, even short term or intermediate term bearish, there's reason for it. I don't get bearish just to get more clicks. I get bearish when I see stuff on the charts that tell me it's time to be bearish. So yes, we've had a good 3 days. Yes, Google's going to gap up. Yes, the market's going to gap up. NASDAQ's looking great this morning. But that doesn't change anything in terms of higher interest rates and higher inflation that we're going to have to deal with over these next couple months. The narrative will continue to evolve over these next few months. All right, let's take a quick look at Google. Google reported, and it just opened. I'm going to try and wrap this up here in the next minute or two. But Google, 3,027. So it is opening at a high. Let me get back. Let's look at that chart and get that relative strength. So we did open above 3,000. Is this going to be a head fake that's going to get a lot of people, jumping in on this gap and then we fail? We won't know that until later today. But I can tell you this, with all that interest and that huge gap up, you probably got market makers on the short side, which tells me in the near term, I would probably bet on a pullback as opposed to a continuing move to the upside. But we'll see. That was a strong report Google had. I mean, they came out, they blew their numbers out of the water. Expected to earn $26.69 per share. They came in 30.69. They announced a 20-for-1 stock split. That's going to take them back down to $150 a share. Their speculation will be added to the Dow. I mean, there's a lot of positives in this report. So a lot of people are going to be jumping in, but we'll see how we close today. I think that's going to be more important. The other thing I just wanted to point out on Google is Google has been performing very well relative to the internets. Internets have been horrible, but Google relative to the internet has been very strong. And, so again, Wall Street on a relative basis liked Google among its peers. And today we're seeing why. So this relative strength indicator is always important, I think, going into an earnings report, and we'll just see what happens. Let's go ahead and pass on the three you must see today. Look, Google already back down to $29.92. They went $30 or $40, whatever it was. Let's get a quick update on the market, though, and see what the market's doing. Dow up 19, S&P up 19. NASDAQ up 106, up 0.75%. I know at one point futures were up like 1 3/4%. So let's see what happens the rest of the day. I'll give you at least some things to think about. Whether or not the market goes higher or lower from here, nobody knows for certain. But we can look at some of the cues that the market's giving us. And I just think right now I would be very, very careful, because I do think from an intermediate term perspective, that we need to reset the sentiment. The sentiment's just too low. I mean, look back at the last 10, 20 years. I mean, we've never seen it like this. And so it's going to take some time. You just don't go from very bullish to very bearish overnight. It's not one reading, one day's reading on the put call. It's going to get that 253-day moving average to continue rising. It's going to take a period of, much more negative sentiment. So with that, I'm going to wrap up. Listen, everybody have a great day. I'll be back tomorrow over at Stock Charts TV for your next Trading Places live episode. Be careful out there. I mean, the whipsaw is going to be everywhere probably. So just, do what you can to protect yourself. Have a great day, everybody. Happy trading.